Hey, what's up, stock compounders? So it is Q&A Saturday. So I have 6 questions here that I'm going to be doing my best to answer. So let's jump right in. The first question, I've been holding cash, waiting to jump in at the next free fall, the next market downturn. Should I go in now or keep waiting? So this is really a market timing question. And I'm not a big fan of trying to time the market because in my experience, you're going to miss out maybe more often even than you're going to be able to buy in at what seems like a low price. So the issue with trying to time the market, for all of those people who have been out of the market since 2013, 2014, 2015 because it seemed high then, the bull market obviously continued we're kind of still at a pretty high price compared to, market prices as compared to 2013, 2014, 2015. So there's an expression, time in the market beats timing the market. So there's really 2 camps here. Are you passively investing in index funds? If you're in that camp, I would say you want to come up with a plan to deploy your capital. So say you have a bunch of cash waiting to get into the market. I'd say maybe over the next year and a half, 2 years, plan to have all of that invested. So every month or every quarter, you've got a certain percentage, and then, say there is a crash in the next 6 months or next 9 months. If you have it spread out far enough like that, then you're not putting it all to work when the prices are potentially elevated. You're kind of dollar cost averaging your way into the market. If you're buying individual stocks, it doesn't make sense to be waiting to jump in when there's a market crash because you're looking at individual stocks. You're looking how the value of an individual business compares to the price of stock in that individual business. And, obviously crashes are going to affect individual companies differently. High markets, potential bubbles are going to affect different companies differently. I was looking at something the other day where, the top 50 companies in the S&P 500 are really driving the performance of the S&P 500. The bottom 450 companies have lost money since the beginning of the year. But since those big companies make up such a large percentage of the S&P 500, it's pulling the whole thing up. I don't try to time the market. I think it's silly to try to time the market because you're just more often going to miss out than you're actually going to serve your portfolio to try to time the market. So that's my answer to that one. Number 2, what investing books should I read as a beginner? So I've got 5 books here. They're not necessarily the top investing books of all time. I think they're investing books that are underappreciated. Okay, so this isn't an exhaustive list, but I think these are fantastic books. The first one, The Little Book That Still Beats the Market by Joel Greenblatt. Joel Greenblatt is one of the top hedge fund managers ever. He's also a business professor, okay, or he was. So he writes in such a clear, lucid way, and it's a very easy read, and it really, I think, does a fantastic job of kind of giving an overview of how to do well investing in the stock market and how the stock market works. So fantastic book there. Number 2, The Intelligent Investor. Just recently, I've highlighted 2 chapters in this book, chapter 8 and chapter 20. Warren Buffett says, those are really the 2 chapters you need to master as an investor to do well as a value investor. But of course, Buffett up here calls this book by far the best book on investing ever written. And it is fantastic. It's somewhat dense. Obviously not as dense as Security Analysis by Benjamin Graham, but if nothing else, check out chapter 8 and 20. And you can also listen to those on Audible. I like to listen to it on Audible and kind of highlight as I go through. That helps me absorb the material better. The third one, The Dando Investor by Monish Pabrai. Monish Pabrai, if I had to have an investment guru, if I had to pick an investment guru right now, it's Monish Pabrai. He puts out some awesome videos, maybe 3 or 4 a year, guest lecturing at business schools around the world, kind of talking about his investment framework, and he has an incredible track record. I like following him more than I like following Buffett because he manages a lot less money, and so he's looking at much smaller opportunities, which is much more in line with the kinds of opportunities that I'm interested in as a small investor. But anyway, I can't speak highly enough of Monish Pabrai. Number 4, 100 baggers. Stocks that return 100 to 1 and how to find them. This is by Chris Meyer. Now, Chris Meyer puts out an email newsletter. I think he probably does a blog post that goes out to that email list maybe once every 2 weeks, and they're fantastic. They're fantastic. They really get me thinking about different topics on investing, and he usually highlights a company or two to kind of express through an example of the topic for each blog post that he does. And it's a great book, kind of distilling, what are the 4 or 5 qualities that show up in a lot of these 100 baggers. And I actually used some of those to kind of narrow down my magic formula investing stock picks that I put out a couple weeks ago, and I'll be doing that every quarter. And then the last one I want to mention, The Most Important Thing Illuminated by Howard Marks. And this has a foreword by Warren Buffett. Warren Buffett is a big fan of Howard Marks. And it's really I think it's about 21 most important things. So, Howard Marks, he puts out a lot of these memos and he's always highlighting something that's the most important thing. And so he compiled 21 of them. And it really just showcases that there's just a lot of different things to think about if you want to do well investing. And it's very concise. It goes into kind of each of these areas that we really need to understand as investors if we want to do well over the long term. So check those 5 books out. Can't recommend them highly enough. Question 3, what have I been thinking about this week along the lines of investing? So I've really been thinking about this phrase that goes something like, when there's nothing intelligent to do, the intelligent thing to do is nothing, okay? As investors, we really have this temptation to tinker with our portfolios. And, over the activity, to have a lot of activity. We think, the more activity we have in our portfolios, the more productive we are, the better results we're going to get. But that's actually opposite, it turns out. For investing, usually it's the people who do the least in terms of buying and selling and massaging the portfolio that tend to have the best results. And really it's because it's infrequent that there's something intelligent to do. Okay, especially if you're in the value investing camp, the kind of concentrated stock picking approach. It's rare that an investment idea comes along that kind of clunks you over the head as kind of an obvious, no-brainer investment opportunity. Okay, and usually when you have a great investment opportunity like that, you want to let it ride for a lot longer than most people are comfortable with. So, I've been thinking a lot about that, how, it's tempting to be busy. We think when we're busy, we're more productive and we're squeezing more out of the apple, but that's really not true with investing. So one of the things I've been focusing on to not have so much activity in my portfolio is to focus on educating myself when there isn't anything intelligent to do with my portfolio. So that involves, reading the books that I mentioned, watching, Monish Pabrai's lectures on YouTube. There's a ton of other great investors out there that put out content on YouTube and through their own personal websites. Looking at investment write-ups on Value Investors Club, looking at 13F filings and trying to reverse engineer why super investors bought what they did in the last quarter, through reading annual reports and write-ups on Value Investors Club, just trying to get in the minds of those super investors. Monish Pabrai mentioned hiring a few interns and figuring out all of the big mistakes that great investors have made and trying to figure out, could those investors have seen those mistakes before they made them? And, what could they have seen in that business that might have indicated that there might be a red flag there? So there's so many things to do to educate oneself as an investor, instead of being active in your investment account. So that's something I've been thinking about this week. Number 4, so I had a friend reach out to me and he said, I'm paying my investment manager currently $2,500 a year, and I don't think he's doing all that much. So this friend was curious if I might be willing to manage his money for him. And, I sat with that a little bit. I'm still sitting with it, but what's coming up for me, when you have a friendship with someone and you kind of get entangled with the finances, you really want to make sure your expectations are aligned. I remember Warren Buffett talking about how when he started his original Buffett partnership, he had like 20 friends and family that, were interested in investing with him. And he really had to be very clear about what his ground rules were, how he was going to invest their money, and what their expectations were for how much he was going to be communicating with them. Do they want to see, what are my quarterly or monthly results? And if you're in a situation like that, sometimes it just doesn't mesh with the investment approach. Like that wouldn't have worked for Buffett. Of course, Berkshire Hathaway, I think they, in the annual meeting, they talk about their investment performance once a year and answer questions. And, any more frequently than that, and you have incentives as an investment manager that tend to clash with kind of a longer term investment horizon. We really don't care about those short-term wiggles or volatility in stock prices as long-term investors, but you have to make sure your clients are on the same page. Otherwise, it just gets messy. So I don't think I'm going to take my friend up on this. There doesn't quite seem to be alignment in terms of what he's looking for in his investments and how I operate as an investor. And, it just seems like there's too much potential there for bad blood, even if the investments do pan out. It's really important to be completely aligned if you're going to manage somebody's money like that. So just thought that was interesting. Question 5, what game will make me a better investor? I've been thinking a lot about, what games can I learn? What can I get into that might actually have a positive impact on my investing? Some of my housemates, so I live in a house with 5 adults, and a couple of my housemates have been interested in chess. So I've been learning chess, but I have this sense that chess isn't really going to help me become a better investor. I mean, it keeps the mind sharp. It's kind of a fascinating game, But the game I'm really interested in is actually bridge. And you might hear that and think, oh, that's for old people. It is a dying game, unfortunately. There's not a lot of young people who are getting into it. But I'm really interested in bridge largely because Monish Pabrai, is really into bridge. Buffett plays bridge. Charlie Munger plays bridge. And I've actually heard them say, it's really a game of assessing probabilities. And obviously there's so much overlap between, assessing probabilities and investing. That's really how Pabrai and Buffett and Munger think about investments. What is the probability of upside and how much upside versus the probability of losing money and how much money. And so I think bridge would be a great game for me to really get into, to improve my thinking as an investor. So fortunately, I have another friend who is also interested in bridge. So I think we're going to do some kind of deep dive learning together and then get on BridgeBase, which is kind of the big online platform for playing bridge. And I'm excited about that. So I'll keep you guys posted on how that's going. And then finally, number 6, someone asked me to value AMD a few months ago, Advanced Micro Devices. And I've been meaning to do it. And what I realized, what I wanted to share about AMD is, as a value investor, I think it's a lot more important to say no to opportunities quickly than it is to try to find compelling investment opportunities, okay? And, because AMD doesn't check a number of boxes for me, none of the investors that I kind of respect and follow their 13F filings, none of them own AMD. There's no recent write-up on Value Investors Club for AMD. If I look at, it's not on the magic formula. If I look at Magic Diligence and check out the earnings yield and return on invested capital, the earnings yield is quite low for AMD. So there's nothing about those initial screening criteria for me that say, hey, you should take a closer look at AMD. So for that reason, I just don't have any interest in valuing AMD or other companies that don't at least check a number of those initial criteria boxes. Because in order to do a good job of valuing a company, you've got to be interested in the company. And you've got to do a fair bit of digging to understand how the business works. I'd have to read through the annual report. I'd probably have to listen to maybe the last few earnings calls and just really wrap my mind around the business. And, because it's not compelling from any of those initial, funnel criteria, I wouldn't do a good job of valuing it. So I'm going to take a pass on valuing AMD. And I encourage you guys to be much faster to say no to potential investment opportunities than to go out and try to find investment opportunities or, try to talk yourself into investment opportunities. Really, the best way to do this thing called value investing is to be quick to disqualify investment opportunities. And then once you have an opportunity in front of you where you're just having a really hard time disqualifying it, that's when you take the time to really go into it, to read the annual report, listen to the earnings reports, and try to understand the business. Read the Value Investors Club write-up. Maybe some of the super investors that own it have talked about it in different situations. So try to find, those nuggets to really sink your teeth into the investment thesis around it. So that's what I'll say about that one. Be quick to say no. This is really a game of being unreasonable. Okay, so say no as quickly as possible. And if you're having a really hard time saying no, that's when, you know, you really get into it. So that's it, guys. I just wanted to answer those 6 questions today. Like always, leave a question below if you want me to answer it next week. And I will absolutely answer any questions that you guys post down in the comments in the Q&A next Saturday. So in the meantime, be well. I'll see you guys tomorrow in the next video. Take care.